You ever glance at the currency exchange rates and feel like they're just random numbers pulled out of thin air? Well, they're not. Not at all. Each one is actually telling this incredible story, a story about a country's economy, its place in the world, and even the psychology of millions of investors. And right now, the story of the Indian Rupee, it's a real page-turner.
So let's get right to it. The big question we're all asking, especially if you deal with anything connected to India, is pretty simple. Why is the rupee hitting these record lows? We're going to peel back the layers and see what's really going on behind the headlines.
And look, this isn't just some minor dip we're talking about. The rupee has crossed a huge psychological line, touching 90 to the US dollar. That's a big deal. It's not just a number on a screen. It has very real consequences for everyone, from the biggest corporations right down to individual freelancers. So figuring out the why behind it, that's absolutely crucial.
All right, so here's how we're going to break this all down. First, we'll take a quick trip back in time to look at the rupee's journey. Then, we'll pop the hood on the economic engine that drives its value. After that, we'll get into the wild card, human sentiment and global shocks. We'll also see what tools India has in its toolkit to defend the currency. And finally, the most important part, we'll talk about what this all means for you. Okay, first things first, let's get some perspective. Today's exchange rate is just a single moment in a much, much bigger story. You've got to know the past to really understand the present, right? This timeline, it's like a snapshot of India's entire economic journey. Just think about it. Back in 1947 at independence, a US dollar cost just a little over 3 rupees. Wow. Fast forward to 1966, a major devaluation happens, and it jumps to 7.5. Then 1991 comes along, economic liberalization completely changes the game, and we're past 24. And that brings us to today, staring down 90 and maybe even higher. Every single one of these numbers tells you something huge was happening in the country at that time.
Okay, so that's the history. Now let's pop the hood and look at the engine itself. An economy has all these different dials and levers, and a few of them have a massive direct impact on the currency. These are the hard numbers, the data that traders are glued to 24/7.
First up, a big one, inflation. It's pretty straightforward, really. If your money buys less stuff at home, it's going to be worth less to folks overseas. High inflation just chews away at a currency's power. I mean, for a wild example, just look at Argentina. When their inflation went through the roof, the peso just tanked because everyone was scrambling to get their hands on US dollars to protect their money. On the flip side, low and steady inflation, that's a sign of a healthy, well-run economy, and that supports a strong currency.
All right, next up, interest rates. Think of these as a giant magnet for money from all over the world. When a big central bank like the US Federal Reserve cranks up its interest rates, investors everywhere say, hey, I can get a better return there. So they pour their money into the US. What does that do? It creates a huge demand for US dollars, making the dollar stronger and, you guessed it, other currencies like the rupee weaker in comparison.
Then you've got the trade balance. Simple idea. If you sell more to the world than you buy, like Germany or China, then foreigners need your currency to buy your stuff. That pushes its value up. But here's where it gets kind of weird. The US buys way more than it sells, a huge trade deficit. Logically, that should make the dollar weak, right? But it doesn't. And that's because the dollar's king. It's the world's main reserve currency, so everybody needs it for trade, for oil, for just about everything. That creates this constant built-in demand that keeps it super strong. And it's not just those big three. Traders are watching a ton of other things. Strong GDP growth? That's a huge green light for investors. And India's been posting some amazing numbers. Good job reports? Another sign of a healthy economy. But on the other hand, a country with massive, out-of-control debt, that's a major red flag that can send investors running for the hills. But you know what? If it were all just about spreadsheets and economic models, this would be a lot easier to predict. The truth is, there's a huge human element. We're talking about feelings, fear, greed, and pure shock. This is the wild side of currency markets, where things can go sideways in a heartbeat. Okay, brace yourself for this number. Every single day, over $7.5 trillion are traded in the foreign exchange markets. That is a mind-boggling amount of money. And here's the craziest part. Something like 90% of that isn't for buying goods or services. It's just speculation. It's people betting on which way currencies are going to go. And when that much money is involved, what people think will happen can actually make it happen. A lot of this is what they call hot money.
It flows into a country like India. We're talking over $620 billion worth when times are good, looking for a quick profit, and it strengthens the rupee. But it's called hot money for a reason. It can get cold feet and run out just as fast. Remember the start of the COVID pandemic in March 2020? In just a few weeks, almost $16 billion vanished from Indian markets. That puts incredible downward pressure on the currency. At the end of the day, there's one thing markets hate more than anything else: surprises. They want stability. They want to know what the rules are. A big political shock can cause absolute chaos. I mean, the perfect example is Brexit. The result was a total surprise, and boom, the British pound dropped more than 10% literally overnight. It just goes to show you how tightly politics and currency are linked. So, after all that, you might be thinking a country is just a boat getting tossed around in this giant global ocean. But that's not the whole story. They aren't helpless. They have their own set of tools, a whole toolkit designed to manage these storms and keep the ship steady. The number one tool, the big one, is the country's foreign exchange reserves. The easiest way to think about this is like a national rainy day fund. It's a huge pile of stable foreign currency, mostly US dollars. If the rupee starts to fall too fast, the Reserve Bank of India can jump in, use those dollars to buy up rupees, which increases demand and helps stabilize things. It's their main line of defense against market panic. And let me tell you, India has been building up a serious fortress here. Just look at this. The country's reserves have shot up, hitting a record of over $650 billion. That's a massive financial cushion. It gives the central bank a ton of firepower to step in and calm the markets, sending a message that they can handle whatever gets thrown at them. It's not just about spending reserves, though. There's also monetary policy. This is the central bank's overall strategy, their playbook. They can tweak interest rates to make holding rupees more attractive. And honestly, a huge part of this is just trust. When investors and markets believe that the RBI knows what it's doing and is serious about keeping things stable, that confidence alone acts as a powerful anchor for the currency. All right, we've talked history, economics, global markets, the whole big picture. But let's bring this right down to earth. What does a rupee at 90 actually mean for you, for your business, for your bank account? You've really got to see a weaker rupee as two sides of the same coin. On one side, if you're an exporter or maybe a freelancer with clients in the US or Europe, this is fantastic. Every dollar you earn suddenly turns into more rupees. It's like getting a raise without asking for one. But then there's the other side of that coin. If you import goods, if you're a student studying overseas, or even if you just like buying things made abroad, well, it's a price hike. Everything just got more expensive. So let's just sum it up. For anyone running a business or even just managing their own finances, here's how this hits your bottom line. 1, it directly impacts your earnings if you get paid from overseas. 2, it changes your costs if you use imported stuff like software. 3, on a macro level, it can actually make Indian products cheaper and more attractive to foreign buyers. And 4, for everybody, it just throws a wrench into financial planning. Budgeting gets a whole lot trickier. So, when you boil it all down, what's the one thing to remember? It's this: a currency's value is never, ever a random number. Think of it more like a live, dynamic score. It's constantly updating, reflecting a country's economic health, the amount of trust the world has in it, and how well it can handle all the chaos of the global economy. And that really leaves us with one big question to chew on. In a world that seems to get more chaotic by the day, there's always a trade-off between pushing for fast growth and maintaining stability. So you have to ask yourself, what is the real price of keeping things stable?